I'm Dave Butterman, with Summit Consulting, and I guess I've been in and out of public accounting for 30 plus years, 35 years. Started off Parker Anderson, just to kind of give you some background. Started in the tax department, so I've been doing that my whole career. I've been a CFO as well, so some of the business things that you probably are going to run into, I've dealt with also. You know, I know a lot of this is going to be about independent contractor, but, you know, I can also answer W-2 questions if you're part of management and an employee with Hometown Realty or whoever. Okay? So don't feel that just because we're dealing with independent contractor and 1099 issues, that's the only thing. You know, feel free to ask other questions as well. So I know a lot of the CBRE, they just kicked everybody over to 1099 and take everybody off of wages. So, you know, what are some of the considerations as you go off and are becoming a 1099 person? Well, one of them is, what type of entity should you be? There's a whole slew of entities, both legal and tax-wise, and the tax ramifications are very different. And I'll talk about that here in a minute. You know, what are some of the legal liability issues you should consider? How do I set up my company? What's deductible and what's not? And then how is my company and how am I taxed? And again, that goes back to what type of entity you choose to be. So now because you're 1099, one of the things that comes into consideration is how am I going to be taxed? What is my income going to look like? And and how is that going to be reflected on my tax return? Well, that goes into what type of entity I am. So, you know, you can choose to be a sole proprietor, a partnership, an S corp, corporation, a C corp, what they call a C corporation or a limited liability corporation. All of these have different tax ramifications, specifically around self-employment tax and whether or not you get double taxed as well. So if you're a sole proprietor, that's just, you're reporting a Schedule C on your tax return. You're just collecting your 1099, reporting it as under your Social Security number. You're taking your deductions, which we'll get to in a few minutes. And that net income that you come down to is what shows up on your tax return. And that's what you pay tax on. But you also pay self-employment tax on that, which is FICA, Social Security and Medicare piece, which is an additional 15.5% on top of the income tax. Now, if you do some of these other, specifically an S corporation, you can get out of, it's just a 2-page piece of paper that you file with the IRS, electing to be treated as an S corp, and it's a separate return other than besides just your personal return. But what happens is you get out of that self-employment tax. You don't have to pay that additional 15.5% on what you earn. You do have to pay yourself a wage, so you will be setting up payroll. But the IRS gives you this kind of nebulous definition of what is an acceptable wage. It just has to be reasonable. Our company this size, what would they pay somebody in your position? If you're making $500,000, would somebody that's the CEO of that company be making $100,000, $200,000, $300,000? They give you plenty of room to kind of play with that. Oh, I'm a new corporation. I'm holding money to expand. New corporation. I'm holding money because I don't get my commissions until the end of the year. However, we can work to kind of massage that number because as you know, with your W-2, you pay Social Security and Medicare. You pay your portion of it. But that's the reason why we try and massage that number and keep it lower so that the rest of the income doesn't get subject to that. Okay? So there is that 15.5% savings if you're an S corporation. C corporations, they get taxed on the net income. And then anytime you take a distribution out of it, that gets taxed as a dividend. So that's where you have the double taxation. I wouldn't think any of you would want to be a C corporation. Limited liability company, all of these can be an LLC. This is more of a legal term, but it does apply to these. You can elect to be, you can set up an LLC, but you can elect to be taxed as a sole proprietor. You can elect to be taxed as a partnership. You can elect to be taxed as an S corporation. You can. So, but there is that different designation. And typically what happens with an LLC is you get, as the name says, you get the limited liability. As a partnership, partners are liable up to whatever the debts are of the company. And you're completely open, not completely open, but to a large extent you are. Same with the sole proprietor. S corp and a corporation, and with a LLC, your liability is limited to what you've invested in the company. As long as you don't personally guarantee anything else or commit fraud, what you put in the company is all you're limited to. So let's say you go out and borrow a ton of money, and you put it leave it in the company. The company's the only one that signed on it. If something goes wrong with the company, you don't have to pony up to pay the bank back that whatever's lost. So that's one of the benefits here of the limited liability corporation, which again, you can elect to be these. As we talked about over here, some of the impacts are the double taxation, the self-employment tax, and then the regular tax. Once you decide what kind of company you want to be, then it's okay, how do I set it up? And it seems like it could be fairly daunting to do, but it's not. It's pretty easy. It takes about 5 minutes. Probably going to take you longer to figure out the name of your company. It's going to take to set it up. The State Corporation Commission, here's the website. You just go there. You come up with a name. You can do a name search, find out if the name's available. If it is, then you go to the next step, which is I want to incorporate. And on there, it'll ask you what type of entity you want to be, what's your address, what's your name, and then you register with the state. And they give you, if you're a partnership, they give you an operating agreement. If it's a S corp or a corporation, they give you an articles of incorporation, which is a one-page document that just has your name, the date that you're incorporating, a signature from the State Corporation Commissioner. And that's it. It literally takes 5 minutes to do. And you can do it all from that site. The other alternative is you can have a lawyer set it up. The only way I'd kind of go down that route is if you had like multiple people coming together and you had to figure out, okay, how are we going to share these profits? How are we going to, are there other considerations that we need to provide for? Are we going to have key man insurance that so only somebody's going to get paid out, or that type of thing? That's when you want to get the lawyer involved, who has a lot more experience, in drafting up the partnership agreements or the articles of incorporation, the specific terms in there that you need to have. But if it's just you and you're the only owner of the company, you don't need to go that route. You can keep it simple. After that, it's just filing with the IRS for an EIN. It's online. You can do that with the IRS.gov. Again, it takes about 5 minutes. You just put your name, you're putting your address, you're putting who the principal of the company is, and then that's it. You're done. Submit, and they spit it out right there. And then you need to register with the Virginia Department of Taxation. Again, fairly quick. You'll have to set up an account with them, and you log in and fill out the information. You give them, essentially, you're going to give them what you filed with the State Corporation Commission. You'll give them your EIN. You'll tell them whether you're going to have employees or not, and when you expect to have them, and you're pretty much done at that point. state also kicks out your state registration number very quickly. Okay. Here's probably the one that everybody's more interested in is, what can I deduct? What about my dog? Can I deduct my health insurance? Can I deduct my gym membership? Can I deduct the clothes that I need to go, when I dress up to go to meet clients? I just listed a couple of things because I didn't have enough paper to list everything. Screen time. But, feel free to ask me questions now. I mean, I'm sure you guys probably have some about what is deductible and what's not.
Okay, so I'm new to real estate, spent half of 2024 on a W-2 until my contract ran out, jumped into real estate, have made 0 sales, so I have no 1099. But all the expenses that I put into becoming a realtor, I don't know, $3,000, $4,000, $5,000, is any of that deductible because I spent half the year as a W-2?
Yes. As long as you set up your company.
Okay.
It used to be if you were W-2 and that was it, and you itemized, that was how you got to deduct those types of things. It would be in the unreimbursed employee business expenses or in the itemized deductions. Well,
which I've researched don't exist anymore.
5 years ago or 8 years ago, those are gone.
Stupid company.
So,
sorry.
I agree. So that's gone. But if you have your own company, you run it through the company and deduct it there. And it doesn't matter. I mean,
I can set up a company even though I have 0 sales on a 1099.
But eventually you're going to have sales, right?
Let's hope.
Yeah. So, you're anticipating, you didn't get into this to not make any revenue.
That is true.
So even if you don't have, a lot of companies won't have any sales. Look at some of the internet companies. They have no sales and haven't for years. But as long as you anticipate having income and that is what your goal is and what your efforts are driven towards, then yes, you can set up a company. It's got a business purpose and you can take those deductions.
Even though I haven't set it up until 2025?
That's what I was going to say. So, I don't know if this is still valid, but when 8 years ago, activated my license, my accountant told me to keep track of everything, because I had an inactive license for 6 years, keep track of all my expenses for all those years. And then the year that I start making money, deduct that as startup expenses. And it was 6 years worth of expenses.
Yeah.
That's maybe if you didn't set up till this year, that may be the safer bet.
Yeah. Okay. I'll give you the technical answer. The technical correct answer is no, you can't. But the way you can technically still be is the way Suzanne just said it. You could say, okay, these are all startup expenses and me investigating, getting into this, me getting licensed for it, and that type of thing. You can do it that way and amortize it over 5 years. Depending on how much it is, you may be able to amortize all of it in the first year. You can make an election to amortize up to $5,000 startup expenses all in the first year.
Okay. So I have to set up
just keep really good records.
So I have to set up the LLC to be able to do
I
it.
did as a sole proprietor. I mean, I was a 1099 the first year because I was dual career, and there was no way I could go through the whole LLC S corp thing that year. I was like, no way. But I was able to deduct them. Is that right?
Yeah.
Okay.
Yeah. I mean, you can do it. You can do that as a sole proprietor. So for 2024, yes, do it as a sole proprietor. A lot of companies, even S corps, partnerships, and stuff like that, they do start off as sole proprietors, Schedule Cs, and then they convert to an S corp or partnership or whatever later on.
But I can set up a sole.
You don't have to set up anything.
You can still be 1099.
It's just you, and it's Schedule C, which is literally just the profit and loss analysis as part of your tax return.
I'll help you. I'll help you. I
Okay.
have good records for 6 years.
Why would you choose an S corp over an LLC or vice versa?
Well, an S corp is an LLC.
Okay.
So remember, LLC is a legal term, and S corp, partnership, sole proprietor, those are all tax terms.
Got it.
So you can elect to be, for legal purposes, an LLC. And when you're filling out the forms for the IRS and stuff, they'll make it look like an LLC is a whole separate designation.
It's so confusing.
It's not really. It's more of a legal term than it is an actual tax term.
Got it.
Okay. So, but yeah, for legal purposes, I'm going to elect to be an LLC, and then when you get to the tax side of it, I want to be taxed one of these ways. And again, the S corp, the benefit is getting out of the self-employment tax, or reducing the impact of that self-employment tax. So, on your expenses, make sure you save everything. You don't necessarily have to give your accountant everything, but you need to have your own backup.
So I've set up an LLC, but I don't think I've chosen which S corp or sole proprietor, whatever it may be. But when it comes to like paying taxes, which one would you recommend to like? And I also with an S corp, you said that I have to designate a certain amount of income to be paid to myself. I'm brand new in the industry as well.
You don't have to do it in the first year. Just once you get going, then at that point, start set. And you don't have to say. Okay, I'm going to pay myself $50,000. You can adjust it on the fly during the year. You can say, okay, I'm going to pay myself a base because I have no idea what I'm going to make. I'm going to pay myself $500 a month and see how it starts off. And then, okay, if during the year you prove that, hey, I'm going to make $100,000 or I'm going to make $300,000, you can adjust it. Or you'd say, hey, I had a great month this month. I'm going to pay myself an extra $12,000.
We're actually the same as y'all when we get paid from 1099s, the four of us sitting here. So we don't even, these questions are great, but we don't know the answer. We have Dave help us because we're like, what do we do? How do we set this up? How does it go the right way? And so it's like, yeah, you can easily do it online, or I'm like, Dave, I still don't have an EIN. What was it, 6 months later? And I had a lawyer set it up, by the way, and we still didn't have an EIN. So Dave figured it all out, which was really, really cool to have someone in your corner, because what we do for a living and what y'all do for a living is like, this is like reading Braille. It's like, I can't figure out what we're talking about here. So we get that part of it. It's just not easy. It's the government, it's taxes, it's the worst. So I get it all, but we're in the same boat.
Well, it changes every year, too.
And it changes every year.
So if you're married and you file joint, my husband's a W-2, I'm a 1099, we have kids, is there a benefit to just continuing to be a sole proprietor, or is there a benefit to me doing the S corp, and can we still file jointly, or does that separate?
No, you can still file jointly. The benefit to filing as an S corp is the self-employment tax aspect of it.
Yeah.
The detriment to being an S corp is you got another return that has to be filed. You got a company return that has to be filed, and you do have to set up a payroll service and process payroll. Now, yes, that will eat into some of that, self-employment tax savings that you're going to have, and you got to kind of do that calculation of, okay, where does it make sense for me to make this jump? Because the employment, the payroll service is going to be probably probably $30 or $40 a month. And then at the end of the year, when they do your W-2s and stuff, you'll probably get your for $100. So, I mean, there is some cost to that.
Sure.
But, I find that usually once you're making more than $20,000, it makes sense to go ahead and switch and set up that company. And again, you can still file with your husband jointly. The rest of your return will look the exact same. You just won't have that Schedule C. Your S corp will have a K1 that it kicks out as part of its return, and that's what you report on your personal return, is that income. Okay? And you'll have a W-2 as well at that point. that you're
So then,
reporting.
if you do that, you don't have to submit your taxes on your own like you do with the, or you see you still have
Yeah,
to
you-
pay your quarterly taxes.
Yeah,
Okay.
yeah, you're still paying
That's
your
the main
quarterly
tax.
taxes.
Okay.
The one benefit, another benefit that the S corp gives you is that, kind of back to what we were talking about, government changing the itemized deductions, or where they limited the state tax deduction to $10,000. Well, they provide, most of the states, in order to counteract that, have allowed what are called flow-through entities or pass-through entities, which is an S corp or partnership. They can pay the state tax on the corporate return, effectively giving you an unlimited state tax deduction against the federal income. So that's how they're allowed. So, you pay, the company will pay the state tax related to the income that the corporation has, and then you get to claim it as a credit on your personal return.
Bottom line is he's really smart. I think that's what that
So
was.
if you were brand new getting into it, what would you do? Like what route would you take?
I'd set up the S corp.
Okay.
What was the question?
Brand new agent.
Brand new.
Yeah, I'd set up the S corp.
Okay.
So,
It doesn't cost that much money, right? What are we talking? $50 or something?
The initial fee I think is $225, but then each year after that you've got your license. You've got your license, which is $50.
Gotcha.
You got it back. And that's just the annual registration.
Alright, so thank you.
Some of the things that maybe you guys have or haven't been deducted in the past has been your internet, and yes, you got your office, but if you've got a home office too, you get your home internet, you get your cell phone. If you've got a home line, you get that. Again, if you're deducting, you get the opportunity to deduct your house, or not your whole house, but the part of your house that you use as an office. And what happens with that is they say, okay, 10% of your house is what you use as a home office. Well, add up all the expenses that you had for your house. Your utilities, your water, your gas, your repairs, your lawn care maintenance, your housekeeper. All of that, you get 10%. And that goes as a deduction to reduce the income you've had for that year. Okay? Plus, you also get the qualified business income deduction, which is 25% or 20% of the net income of your business. So if you earned $100,000, you're going to get another $20,000 deduction after on your personal taxes. To your car, you can either take. It depends on your company can buy the car, and the company gets to then deduct that. You get the accelerated depreciation related to that. The one thing you kind of want to watch out for is make sure that you're using it more than 51% for business use. Because otherwise it's personal and you can't deduct any of it. Then you drop back to the mileage at that point. And you've got to track your mileage. And they're sticklers about that. You got to keep a little pad in your car, write down how far you drove that day. You got to
There's a
remove
great free app.
expenses and all
There's
that
a really
stuff.
good free app that
Yeah.
tracks when you're moving.
Yeah.
Everlitt's. Into my IQ. That's another.
I think we've gone over a lot of this, or touched on it, and gone through it some. But, as I was saying, once you choose what entity you are, if you're a sole proprietor, it's just going to show, it's just going to be part of your personal return. It's going to be what's called a Schedule C. And that's where you report your income and the 1099 that you receive, and then you also report your expenses. It will then, the pass-through entities, they'll have their own separate return that you prepare and file, and they generate an informational return called a K1, which you then include in your personal return, and that's just reporting the income the company made. And then I guess, as I just said, you've got the additional return that you'll have to file. So that's all I got. Any other questions or?
I just have another question because I, did not go into accounting for a reason. So again, I'm not going to get a 1099. I have $0 made. I can still file a Schedule C?
Yep.
Okay. Sounds good to me.
Yeah. I've got several clients who are in the technology space. And as you may or may not know, companies waffle back and forth between, okay, I'm going to have them as a contractor, I'm going to have them as an employee. Anybody that knows anybody at Capital One, their tech guys are every 6 months getting shifted back and forth. I've got one that works for IBM. She does all their training. She has $300,000 plus every year in specific costs, conferences and things like that, and certifications that she has to go through. Literally every year for about the first 8 years I worked with her, 1 year it would be this way, the next year it would be that way. So we kept her S Corp alive once they brought her in as an employee the last time. They kept her as an employee for the last 10 years.
Okay.
Well, we keep deducting the expenses. So just in case they flip her back. And we've got the proof that, hey, they have gone back and forth on her. So, and that's fine. She hasn't had income for 10 years, but she's had $300,000 of expenses. So, I mean, those kinds of situations do exist. Yes, the IRS may call and say, hey, why are you doing this? And you explain it to them, and usually they're reasonable. They've seen everything. So,
Okay.
all right.
Good.
You can be an LLC and just operate under your social security number.
Yes, you can.
And you're not filing a separate return then as an LLC. It's just going into your personal return, correct?
Well, if you do that, it's the sole proprietorship route in your Schedule C.
Okay. And that's where you say you get double taxed?
No.
No.
A C corporation would be the double tax.
Okay.
Yeah. If you're a C corporation, you have filed for enough. You filed for an EIN to separate yourself legally from you personally. So.
In regards to investors, bonus depreciation, sort of tax implications, can you just kind of give me as a selling proposition for me to say to investors, like, hey, you buy a rental property, you can write off this much to save you X amount of taxes. Can you just kind of briefly explain how that works? And
Sure.
Yeah,
with depreciation on rental properties, I guess a couple of considerations you got to have is that with rental properties, provided the person is a real estate professional, and that's defined as 500 hours or more in a given year working in real estate, then you get to deduct your real estate losses that you incur, whether it's from just operations or it's generated by depreciation or whatever. If you're less than that, then because of tax law, you don't get to deduct anything. It just sits there and goes into kind of a holding pattern, until you just, get rid of that property. Then everything comes to head all at once in the year that you sell the property. But you do get depreciation. Remember, with the building, unless you go through and say, buildings are typically depreciated either over 27 and a half years or over 39 years. Unless you go through and have some kind of cost seg analysis done, which says, okay, I spent $500,000 on this building, but really this much of it is related to the HVAC, this much of it's related to some tanks or something, something else that makes the building worth more, and here's how much is actually related to the building. If you do that, then you can actually get that, you're not subject to that limitation of over 27 and a half or 39. You can accelerate it to 5 years or all potentially into the same first year.
Yeah.
So there are benefits to looking at it that way. Now, cost seg studies cost money, might not be worth it. It just depends on the dollar amount that you can usually get.
Okay, so you have to be a real estate professional in order to kind of take advantage of something like that.
Yeah. Because buildings aren't allowed to take the accelerated deduction.
Okay.
So I had a deal that closed on the 23rd of December, but I got paid on it on the 23rd of January. Which year is that?
2025. It's when you got paid. Now, that doesn't mean the company didn't try and accelerate their deduction and then include it on the 1099. If they did, then you should push back and say, hey, you didn't pay me until January. Okay?
With setting up an S corp, it's the end of January. Is it a good idea to start it now? How would that affect, if you have had earnings in January, but you're not setting this up till February, does that make a difference?
If you go ahead and set up your S corp and then give your customer a W-9 saying, hey, I set up an S corp. Please give my 1099 for everything that you've paid me under this company name and with this EIN number, then they should honor that and issue the 1099 underneath your new company, and that should be fine. If they don't, there's ways around that.
So you might just get two 1099s. You might get one in your name and one in the company's name.
You may get one in your name and one in the company's name. What I would do on your tax return is, okay, I've got a Schedule C reflect for you personally showing the first 1099, then I'm going to show a deduction for the exact same amount and just say income reported by this company, this EIN number, and then I report the income on your S corp and to get around that.
Good question.
Can you explain when we're talking to our clients, a big question we always get is capital gains taxes. Can you kind of give us the quick and dirty rundown of how to talk to our clients about those?
Okay. For selling of a house selling of a house or investment property, two different things. Selling of a house, personal residence, if it's your personal residence, every individual is eligible for up to $250,000 to exclude the gain home. So if you sold your house for $500, you bought it at $250, you have a $250 gain, and you sell it, you don't have to recognize any gain. Okay? You get that every 2 years. So let's say if you're married, that $250 now becomes $500 because you have that same exclusion as well as your spouse. Okay? When you are doing that calculation, it's the sales price. You've got the commissions that are getting paid. You've got closing costs that are getting paid. You're getting transfer taxes that are being paid. And then when you look at what you bought your house for, that all goes into what is your basis to reduce that gain. You also want to make sure that they're including any improvements that they did to the house. So if they added a bathroom or finished the attic or put a deck or a swimming pool, all of that goes into their basis to reduce the gain when they sold it. If it's a rental property that you own or investment property, then you got to do the same calculation. You just don't have that exclusion anymore. So you're going to have, if you bought your rental property for $250, let's say you never depreciated it because depreciation changes it a little bit. But then you sold it for $250, you got or $500, you got a $250 gain. Well, all of that's going to be capital gain. Okay.
Even if you have expenses against it.
Well, if you've got expenses against it, that gets to go into the calculation and offset it as well. But I'm trying to just use a round number. So the $250 will be capital gain. What tax rate you use will depend on what your taxable income is. So, you could have either 0% tax on that gain, you could have 10%, or you could have 15% if it's long term. If it's short term, held less than a year, then you get ordinary income treatment on that. The 0% hardly ever happens. I've seen that on 2 tax returns in 4 years. So, and it was the same person. Essentially, he had a company that generated an engineering company that generated enough losses that offset all of his income, and then he had a $1 million gain, and he didn't have to pay tax on $1 million gain. So it can happen, but it's not very often.
Just to clarify on the personal residence, they have to own it for 2 years. Or they'll get.
No, you can own it for less, but there has to be kind of a reason for it.
Okay.
Like I lost my job in a transfer and I got a new job someplace else, or I got transferred.
Sounds like the government's more reasonable than we think they are. Like when you talk to them on the phone.
No.
I mean, like reasonable things come up, and then you get I don't know.
But what they end up doing is they prorate it. So they may say, okay, you've done this, you've been there for a year, you only have it in 2 years, so 50%. So.
I got a question on that. With that being said, like obviously if you've owned your house for 10, 15 years or whatever it might be, you've done things to improve it, i.e. new roof, a new HVAC system, you've done a 3rd floor, you've done all these things. Like how many times do you think, and obviously in different areas of the country it comes in different numbers, but in this area, how often do we see people really paying taxes on something like that? But if you go by another one, you're going to spin it into that one anyhow, right?
Yeah.
Right. So, yeah.
Because there's really 2 ways to avoid the capital gain tax on your residence. One is the way we talked about, with the exclusion. The other is the old way, where if you roll over 100% of what you sold your old house for into a new house, that's the other way you can get out of that exclusion, that you can exclude that gain. For those of you who are, buying properties for yourself or even for clients, one of the tricks I kind of tell some people is, okay, buy a house, renovate it, live in it while you renovate it, call it your personal residence, get through your 2 years, sell it, go to the next one, or buy multiple ones and just keep making sure you move and live in it for the 2 years prior to you selling it, so that way you constantly get that rolling exclusion. So
What if you lived in your house for 2 years and then it could begin rental, or 4 or 5 years? A little deeper one.
Yeah, that one. If I think the law says that it's based upon when you're selling it. What is it?
Okay.
Is it your personal residence then? As to whether or not you can use that exclusion. So that's the reason why I say live in it when you're selling it and to get that exclusion. Anything else?
So it's not 2 of the last 5 years?
Well, that's the 2 year distinction. You want to be in it for the 2 years.
But I thought you only had to live in it for 2 of the last 5 years to get that deduction. So
right.
I've got a client right now who is possibly relocating to North Carolina. He's got a house here and he would plans to rent it for 2 years after he moves. And then on that 3rd year, which would be the 5th year, essentially, he's going to, depending on what the market's doing, he'll either sell or keep it as a rental. But I thought you could you were excluded.
You can use it, but it gets prorated.
Gotcha.
At that point.
Good questions.
All right.
Dave,
Thank you.
Appreciate it. I think we'll be pretty brief. Tyler will hop up here and help us out too. But so part of this is like we understand what y'all are going through. Like in some of the stuff he's saying, we don't understand either. So understand where we come from is more the financial advice side. We're going to help you with things like investments, different types of IRAs, different types of how do you grow your business? What's the best things to put in place when you are growing business? Hey, we have partners now. We might want to cover each other in case something happens. But the stuff that Dave just went through is what Tyler White and I and Scott and Tyler and I spend time with him on because we just don't know what we're doing and we try to stay in our lane. And when you think about that, you're busy every day. You're trying to sell real estate. You're trying to help clients make deals with rentals and things in that nature. So our job becomes more of how do we help with your personal finances, right? How do we help you understand that? And then how do we connect you with someone like Dave when you're ready? Because you guys in the back said a couple times, am I ready now or am I not? Well, we're the type of folks that say, hey, buddy, you've just closed 3 or 4 deals. It's time to get with Dave. So you figure out the best way to eliminate taxes or lower them to the lowest level possible. I try to eliminate them as much as possible, but unfortunately, the more money we make, we can't do it. So we are Clearwater Capital. We've been around since about 2020. Tyler White and I founded the company right into COVID. Tyler Lee joined us about 3 years ago. He was a assistant principal for Hermitage High School. About 14 years with the system. Gave up after, obviously COVID. Well, enough was enough. Bureaucracy, as we can imagine. We've all been there. And then Scott just joined our team the last 6 months ago, which we're extremely excited to have him. The level of experience that we have is pretty big. We've been in the business for over, I guess, 50 plus years combined. So good story for that. And then what we do is we try to help our clients get to their goals as much as we possibly can. So what Tyler's going to go through is just a couple pieces, just a couple tidbits. We're going to try to go fast. We want to get you guys out of here no later than 2 o'clock, as Benjamin likes to stick to his time. So
I think one of the big things is that we understand from our end that it's not just your personal finances. It's you and your spouses, you and your kids. There's a lot going on, and everybody in this room has a different situation that we can help you put you in the right spot on all those different areas. So I think that's an important piece to note as well. When we start thinking about building a financial plan, right, many of you are coming in with many different things that you have going on, but when we think about it, we start thinking about building a house, right? And when you start thinking about building a house, the big piece that you first have to have is the land, right? So you have to have that land. And when we think about land, in terms of financial planning, we think about your income. Right, so selling those homes, whether you also have a spouse, right, bringing in that income, that cash flow, and that income is the big foundation that we build upon, right? Understanding every dollar that's coming in, every dollar that's going out, how are we being efficient with that? The budgeting is a big piece of it, and you could probably skip through that a little bit, right? First big piece is building that emergency fund. So a lot of you guys who are starting out, right, if you're just coming out and you're starting your business, or you're starting your life, right? We think about that emergency fund as building that for emergencies and opportunities. So you think about, if the HVAC system goes, or your car breaks down, or you have an opportunity and you want to go on a rental home. Yeah, buying a rental home. All those different things is building some sort of cash reserve to be able to do those things and take care of your family if things were to go wrong. Then you start building the foundation, building that plan on top of that emergency fund. Your work benefits, 401k, insurance, what other investment type opportunities are there? We build on top of that. Then we kind of get to when you're building a house, and you guys know houses way better than I do, but when my wife and I were building our house, right, the foundation was like, okay, yeah, put the foundation down. But now let's talk about the walls, right? Where do the walls go, right? And that's the sexier piece of building a house, and it's also the sexier piece of building a financial plan. So when you think about investments in the stock market and things like that, there are some risks that come along with that. Which you guys are probably all very well aware of. Inflation has been a huge topic over the past 4 or 5 years, right? Inflation rates somewhere 9-10%, maybe higher. Then you have market fluctuation. So when you start investing in the market, it's going to do this, right? So how do we put you in the best position to be able to deal with those ebbs and flows that come with the market? Taxes, obviously, Dave is going to be the one we turn to when we start thinking about that. And then as you age and you think about, okay, I'm going to start to retire, I'm going to start to distribute my money, what does healthcare look like? Those costs are going to come out in some form or fashion. How do we do that the most efficient way? And then longevity. When we sit down with folks who are older, one of their biggest concerns is, I don't want to run out of money when I pull the trigger and go to retire. So how do we mitigate some of those possibilities? We have ways that we can do that. And then after you build the wall and you got all the stuff in it, that you want to protect that stuff, right? So how do we protect that and make sure that your plan is bulletproof? And then there's some ways to do that. Long-term care goes into that, longevity goes into that, healthcare risk, and then income protection, and then the maintenance of the plan. So things are going to change throughout your life, right? You're going to get new jobs. Your spouse is going to get a new job. You're going to have a kid. You're going to have to help a parent or help a brother or sister. Things are going to change. We are there to sit down with you and say, to be that phone call to say, hey, this has come up. I need some help walking through that situation. And we've seen all of it, so we can at least guide you in the right direction, whether it's talking with Dave or other professionals that we work with to try to put you in the best position.
I think the other thing to add to this, and I think it's important to say, is that we work with several folks in the room here, whatever it might be, but we all own rental real estate, the four of us. We are proponents of owning rental real estate. So you'll sit down with a lot of financial advisors that want you to do one thing and one thing only, and that's invest with them. How much money can you give me and how much money can you invest with me? And you can talk to some of the peers in the room that work with us, but ultimately our job is to take your financial plan of what you're looking to do for your future. You guys know real estate very, very, very well. We don't know it nearly as well, so I'd like to find some of those deals that y'all find that like rehabs and stuff like that. However, when I say all this is because other financial advisors out there don't quite give a care about that stuff. How much money can you invest and how much life insurance do you want to buy? And when I think about working with Clearwater Capital, you'll find it completely different. When we sit down with you, your family, we're going to figure out where you want to be and what your goals are. You want to buy rental real estate? That's great. What's the best way to save for that? And how are we going to be able to get the access to money quicker and easier for you all? So different things like that I think are important pieces of the puzzle of what we do a little bit differently than I would say your average or normal financial advisor.
Any questions about that last piece?
They definitely have less questions than they did the last time. So. You want to keep going? You want me to?
Yeah, you go ahead.
It doesn't really matter. Listen, I think that the biggest part about this is we build this into what Dave Muddiman does and what we do is we try to be as tax efficient as possible. And what we all know is that there's ways to be tax efficient and taxes that we just pay consistently on. So as we start to think about things, we say, okay, what's taxable on a consistent basis? Well, if we put cash in the bank and now you can get interest rates at 3.8% at Capital One and things like that, you're going to get a 1099. You have to pay ordinary income tax on that. There's ways to be more efficient with different types of money. And so we think about what's the best way to do that. If we put money away, it's after tax, it grows 1099. And if we're lucky enough, we could pay capital gains taxes on things like stocks, bonds, and mutual funds. And that's what Dave was talking about with real estate, is that you could be at 0, 10, or 15%. Most of the time we see our clients at 15%. But long-term capital gains, knock on wood, they keep it at 15%. There's been chatter in the years past that they're going to move that back to ordinary income rates, which would be not good for anybody. But right now, that's what that is. And that's a good spot to keep money in to buy rental real estate, to purchase another business, to purchase a book of business from someone that has a mountain names that you might want to continue to grow and do those things. Tax-deferred growth, this is going to be a little bit different for most folks in the room. Spouses might have 401ks and things in that nature, but when you're self-employed, it becomes harder and harder. You're like, well, where do I put my money? Do I do a simple IRA? Do I do a SEP IRA? Do I just forget it all and just save my money into the left bucket? The bottom bucket will give you tax deferral. Pre-tax dollars tax deferral, and when it comes out as ordinary income. So people will save money, especially folks like you think about Philip Morris. They'll work there for 35, 40 years and have $2 million in a 401k. They have no idea that every dollar comes out fully taxable to them, just like they were earning income. And everyone's like, well, I'm going to be making less money. You might be, but you also are going to be a higher tax rate as well. So we look at all those pieces. Our job becomes more becoming a tax efficient strategy rather than what everybody normally does. The top one is where we spend a lot of our time, specifically up here being Roth IRA, Roth 401k, and Roth accounts. Those are going to be really important pieces of the puzzle to help you not minimize your taxes today, but minimize your tax in the future. Municipal bonds, good for older folks that just want to have a consistent income stream. They are tax efficient as well. 529 plans for children's education. If you have children in the room, those are phenomenal investment accounts to put money into. You can put a lot of money into them and basically pay for their college. And the younger they are, the quicker and the better it is to start. And then cash value life insurance is something else that we look at depending on the right situation. You truly have to be in the right income class. You have to be in the right segment of your life. You have to be at the right age bracket. It's not meant for everyone. And that's kind of where that gets a bad rap, is because unfortunately a lot of firms out there will sell it to anybody. It doesn't matter if you make 30 grand a year or $600,000 a year. We don't operate like that. So again, after tax contributions, it grows tax free. And tax-free means you don't get a 1099 each year. Just like the bottom one, you don't get a 1099 on that either. But when this one comes out, it comes out 100% tax-free. So if, let's say you have a baby and you put away $20,000 the year your child was born, which I know isn't easy to do, but let's say you're able to do that. And those dollars grow from $20,000 over the next 22 years to where they graduate college, and you didn't do anything else, but they grew at an average of 8%, you're probably looking at over $100,000 in just assets inside of that account. And all those $80,000 comes out tax-free to your child to be able to pay for college. All of it. So it's a very efficient vehicle. Same is true for a Roth IRA. Same is true for life insurance on a cash value basis. So a little bit more on taxes to add to Dave's pieces there. I don't know how much time do we have left. 5 minutes. I don't know if there's any questions on this. I saw some pictures. Happy to answer anything at all with pertains to this, but this is just the normal type of investing routes that you can go down. Got it?
So on the tax advantaged cash value life insurance, I assume that includes it being medically underwritten.
Correct. Yeah. Again, age efficient, tax efficient, money efficient, right? It's just not just the answer of yes, everyone can do it. It is more based on a medically underwritten situation. Anything else? So we look at college funding, we look at retirement planning and other future goals. Again, do we want to buy a rental real estate? Do we want to do this? Do we want to not buy another business? Do we want to open up a food truck that we're going to put it in place and work on the weekends and things like that? There's a lot of ideas out there that people have. Our job becomes is how do we help you get to your goals, not what our goals are and not based on what we're trying to accomplish from an investment standpoint. Yes, ma'am.
I had a quick question about the 529 plan. I've heard that, even if you put into that for saving for your kids' college, if they don't go, you lose it.
Yeah, you never lose it, which is nice. You'll pay some taxes on it, specifically state taxes, and Dave can go into more detail on that. But here's the neatest thing. If you do it, they just made a new rule that if you hold it for long enough, you can convert it into a Roth IRA for your child, which then your child can use for a first-time home purchase, your child can use for other things, or just continue to save for retirement. The other neatest part about it is if you have one 529, you can use it for any child that you want to, including not siblings, right? So if you're the owner of it and you had it for your daughter, let's say, and then she grew up and didn't use the money and then she had a baby, we can change the beneficiaries of the baby's name as well. So it's become a lot easier to maneuver those in a better fashion.